Every year on January 1st, thousands of Americans wake up and realize they missed moves that could have saved them $2,000, $5,000, sometimes $10,000 in taxes. Not because the moves were complicated, because they had a hard deadline of December 31st, and nobody told them in time. Today, I am going to give you every single move that matters before this year ends. Some of these take 15 minutes, some take one phone call, but every one of them has a deadline that cannot be extended, not by your accountant, not by the IRS, and not by any amount of regret on January 2nd. In the next 8 minutes, 3 things. First, what the One Big Beautiful Bill, signed into law July 4th, 2025, actually changed for your 2026 taxes, and which of those changes are permanent versus which ones expire and need to be used now. Second, the 5-year end moves with a hard December 31st deadline, the ones where waiting until January literally cost you money. Third, the 3 moves most people miss that are worth the most, including one that almost nobody outside the finance community knows about. The One Big Beautiful Bill was signed into law on July 4th, 2025. Here is what actually changed for your taxes. The good news first. The 7 tax brackets are now permanent. Your rates, 10%, 12%, 22%, 24%, 32%, 35%, and 37% are locked in and will only adjust for inflation. Capital gains rates of 0%, 15%, and 20% are unchanged. No new taxes on investments or dividends. The standard deduction is permanent and higher than ever, $32,200 for married couples filing jointly, $16,100 for single filers in 2026. Now the critical part. What is temporary and expires? The $6,000 senior bonus deduction for taxpayers 65 and older runs only through 2028. The SALT deduction cap increase to $40,400 expires after 2029. The no tax on tips and no tax on overtime provisions expire in 2028. If any of these apply to you, use them now. They will not last forever. Move 1. Max your 401k before December 31st. The 2026 401k contribution limit is $24,500. If you are 50 or older, $32,500. If you are 60, 61, 62, or 63 specifically, you qualify for a supersized catch-up contribution, bringing your total to $35,750. Here is why this matters right now. Your 401k contributions through payroll must be made by December 31st. There is no grace period. There is no extension. January 1st is too late. If you have not maxed your 401k for 2026, call your HR department or benefits portal today and increase your contribution percentage for the final paychecks of the year. In the 22% federal bracket, an extra $5,000 into a traditional 401k saves you $1,100 in federal taxes this year alone, plus whatever your state taxes. One phone call, one change in a portal, potentially $1,000 or more back in your pocket. A Roth conversion is the move that separates sophisticated investors from everyone else. You take money from your traditional IRA or 401k, money you have never paid tax on, and move it into a Roth IRA. You pay income tax on the converted amount this year. In exchange, that money and all its future growth is completely tax-free forever. Here is why December 31st is the hard deadline. Roth conversions are a calendar year decision. If you want this conversion to count for 2026, it must be completed by December 31st. There is no going back in March. The strategy is to fill your current tax bracket. If you are married filing jointly and your taxable income is $80,000, you have $16,950 of room left in the 12% bracket before hitting 22%. Converting $16,950 of traditional IRA money costs you $2,034 in taxes. In exchange, $16,950 that will grow completely tax-free in your Roth IRA forever. That is one of the best trades in the entire tax code. Let me show you the real cost of missing these moves. Household earning $90,000 per year, did not max their 401k, left $8,000 of contributions on the table. Tax savings missed, $1,760. Did not do a Roth conversion, left $15,000 in the 12% bracket unfilled. Future tax cost on that $15,000 when withdrawn at 22% versus today's 12%, $500. Did not do tax loss harvesting. Had $4,000 in losses they could have harvested against gains. Capital gains tax missed, $600. Total tax savings missed in 1 year by doing nothing, $3,860. Over a 20-year career of missing these moves annually, at an average of $3,000 per year, that is $60,000, not lost to bad investments, lost to missed deadlines. The moves are not complicated, the deadline is. Move 3. Tax loss harvesting before December 31st. The investment move. Tax loss harvesting is the strategy that most people discover 3 days after it is too late. Here's how it works. You look at your taxable brokerage account, your non-retirement investments. Find positions that are currently at a loss. Sell them before December 31st. Those realized losses offset your capital gains dollar for dollar. If your losses exceed your gains, up to $3,000 can offset ordinary income this year. Any remaining losses carry forward indefinitely to future years. The wash sale rule applies. You cannot repurchase the same or substantially identical security within 30 days before or after the sale. But you can immediately buy a similar fund. Sell a VOO loss position, buy VTI immediately. You maintain your market exposure while locking in the tax benefit. The trade date must be December 31st or earlier. Settlement date does not matter. New Year's Eve is a full trading day. Use it. This is the move most people over 65 do not know about yet. The One Big Beautiful Bill created a brand new deduction, $6,000 per eligible person for taxpayers age 65 and older. This is on top of your regular standard deduction, on top of the existing senior standard deduction, available whether you itemize or take the standard deduction. For a married couple where both spouses are 65 or older, that is $12,000 in additional deductions. At the 22% bracket, $12,000 in deductions saves $2,640 in federal taxes. The catch, this deduction phases out for single filers above $75,000 in MAGI and joint filers above $150,000, and it expires after 2028. If you or your spouse are 65 or older and you have not factored this into your 2026 tax plan, talk to your tax advisor before December 31st. This provision is real, it is significant, and it will not last forever. The easy win most people miss. This one costs nothing and takes 5 minutes. If your employer offers a flexible spending account, check your balance right now. FSA money has a December 31st use it or lose it deadline in most plans. Any balance you do not spend vanishes on January 1st. You already saved the tax on that money when you contributed it. Letting it expire is throwing away pre-tax dollars you already earned. What can you spend it on before December 31st? Prescription eyeglasses or contacts, dental work you have been putting off, over-the-counter medications, bandages, first aid supplies, a visit to a specialist you have been avoiding. If your employer offers a grace period or carryover, check your plan documents. But if yours is strict use it or lose it, every dollar remaining in that account needs to be spent before midnight December 31st. Here is the charitable giving strategy that most people miss entirely. The One Big Beautiful Bill added a new charitable deduction for standard deduction filers, $2,000 for married couples, $1,000 for single filers. You do not need to itemize. You do not need a donor-advised fund. You can donate cash to any qualifying charity before December 31st and deduct it even if you take the standard deduction. But if you want the most powerful charitable tax move, donate appreciated stock. You hold $5,000 of VOO that you bought for $2,000. Instead of selling and paying capital gains tax on the $3,000 gain, you donate the shares directly to a charity or donor-advised fund. You avoid all capital gains tax. You deduct the full $5,000 fair market value. The charity gets the full value. You get a deduction worth far more than the cash equivalent. This is one of the best moves in the tax code and only works if you act before December 31st. Move 7. SALT, RMDs, and the 529. The advanced moves. 3 more moves for specific situations. If you live in a high-tax state, the SALT deduction cap rose to $40,400 for joint filers in 2026, up from $10,000. This expires after 2029. If you have been unable to deduct your state taxes meaningfully since 2018, check whether you can now benefit from itemizing for the first time in years. If you are 73 or older, your required minimum distribution must be taken before December 31st. Missing it triggers a 25% penalty on the amount not withdrawn. If you have a 529 college savings plan and your state offers a deduction, contributions must typically be made by December 31st to count for this year. A few states allow contributions until the tax filing deadline, but most do not. Check your specific state's rules today. The difference between a great tax year and a mediocre one almost never comes down to sophisticated strategies. It comes down to doing simple moves before the deadline. Max the 401k. Do the Roth conversion. Harvest the losses. Use the FSA. Donate appreciated stock. Check the Senior Deduction if you qualify. Every single one of these moves is legal. Every single one is documented in the tax code, and every single one expires at midnight on December 31st. Drop the word tax saved in the comments and tell me which move you are doing before year end. I read every single one. And if this video helped you keep more of your money, hit like. It takes 1 second and it helps more people find this channel before December 31st.